please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
This is Bazaar Morning Call, live from the CNBC TV18 headquarters in Mumbai.
Good morning. Welcome to Bazaar Morning Call. I'm Lata and with me Anuj and Sonia. Well, what we've seen now over the past several days is a macro reset. Clearly, we are seeing growth charging ahead. If you looked at especially the US numbers, both housing as well as manufacturing numbers that came in, that excellent growth has led to an all-round rise in inflation as well. Commodity prices. Crude touches $75 per barrel. Now, of course, the 10-year yield as well in the US touching almost 3%, 2.99 yesterday evening. Now, what does this mean for us? It's very clear that the Indian government, while announcing the budget, said that if crude goes beyond $75, then excise duty cuts need to be contemplated. The point is it's going to have a macro impact, whether it is being asked to be absorbed by the OMCs or by the government. The government thinks beyond $75, it's tough for the citizens to absorb. So, you know, we are going to see this macro impact play, the crude because of higher either in the form of higher deficit or in the form of higher fuel prices and, of course, the impact of lower rupee. But one thing we need to remember, while all this look negative, you know, higher yields, bad for banks, bad for those who are borrowing, all this is coming because of growth. We ought not to forget that. And in the past, once we've seen this chain play, that higher crude and higher yields have also come with higher growth, and that has actually been positive both for stock markets and for the economy. That positive aspect needs to be noted as well.
Yeah. Oh, absolutely. I mean, you know, we've been talking about that endlessly, right? Of how higher growth is always good, although it comes with its own repercussions. But in terms of our own markets, Lata, yesterday, although we did see the market sort of, close off the day's highs, post-market hours, we got some really good numbers from the mid-cap space, whether it's Bharat Financial, GNFC, Swaraj Engines, you know, so maybe the market could focus on individual stocks as well. But Anuj, morning, what's the sense you're getting? So far, the buy and dip strategy has worked, but now the market is sort of facing a bit of a hurdle around this level of 10,600. You think that could get taken out, or given that it's expiry, you know, it could go either way?
Morning, Sonia. So 3 days to go for expiry. It's been a good series. One thing is certain, nothing is certain in market, but high probability event that the dips will keep, getting bought at least in this series. Yesterday, the Nifty made an outside day. What is an outside day? When the high is higher than the previous day and low is lower than the previous day. So there's a risk of an outside reversal in pure technical terms.
So in layman terms, what does
in layman terms, that means that the risk of the market topping out somewhere around 10,600 is there. Because there's some fatigue as well at 10,600, and you are now in the classical zone, 50% retracement of the entire correction, and somehow not moving above that. This could be just buying time. Could all be proven wrong. But let's see. Let's take each day as it comes. For the Bank Nifty, 24,800 to 850 is sacrosanct. Limited point is that the risk reward right now perhaps does not favor you to chase momentum. Like yesterday, if you get dips, you buy them. Buying on dips is working, but yesterday selling on rally also worked. So that way, it's now a market which is in a range, and you need to see if this range is breaking. There's still an outside chance of expiry being good, because the series is so good and the bulls have all the momentum. So there's still outside chance, as I said, of perhaps an expiry somewhere around 10,700. That possibility still remains. Today is crucial, of course. A while back, SGX Nifty was indicating very lower opening, and the SGX has been getting it wrong for the last 2 or 3 days. So let's see. IT is the leader. Despite the late profit taking that you saw in last hour of trade, I think that's one space where you will continue to see buy on dips play out. So let's see if the banks can also start to support the market. But I'm getting a feeling that all of this is now preparing ourselves for perhaps fresh round of correction in May. May will have a couple of important issues as well. Earnings season will pick up, and then of course you'll have the Karnataka elections as well. So let's see. But for now, the data is indicating that the buy on dips is still working, and that remains the bigger trick.
No, Karnataka elections, of course, is a different issue altogether. But Anuj, I think much will depend on where the greater weight lies. clearly we are going to see a movement of money from domestic-facing sectors to global-facing sectors, because global recovery is sticking so well. Yeah. So you are going to see IT, you're going to see steel as well, because you have a very cheap rupee now compared to a month ago levels. Yesterday we closed at 66.50. You know, that will mean it's going to be so much more expensive to import steel, and that will give that kind of an elbow room to domestic steel players, domestic aluminum. I mean, you can go on, of course, aluminum today is in a different league because of Rusal and other issues. But as the rupee gets cheaper and cheaper, that wall which makes imports so difficult will give that profit margin to domestic players. So global-facing companies are definitely likely to, you know, have a march over domestic-facing sectors.
On that, you know, the domestic companies, you know, like Mahindra and Mahindra, for example, or Escorts, they have done well. You know, the likes of Jubilant Foodwork, Titans of the world, the entire global domestic consumption space has done well. So, you know, it's because
there is a domestic story as well.
There's a domestic story as well, which is well and truly intact. I mean, if you're referring to only the dollar rupee play, perhaps, you know, I take your point. But
not just dollar rupee. I'm also referring to the fact that you may have banks and OMCs, these kinds of sectors affected because of the rise in yields as well as rise in crude. But I mean, I take your point entirely. The global-facing sectors and consumption sectors within the domestic space are still doing very well. So, on balance, it looks like the Nifty has more winners than losers. And that's why I feel a little confident that 10,600 is a matter of if, it's a matter of when and not if. Because you just have to be part of the global growth story, albeit maybe lagging the growth story.
Okay, well, we have a lot of experts joining us in just a bit to find out, because, you know, the big theme of the day really globally is the way the US 10-year yields are just shy of 3% now, and how that could really change the investing landscape for global equities. But let's take a look at what our wise experts have to say, and then we'll talk about all of that in greater detail. Rhythm Desai of Morgan Stanley says India's most popular stocks are drawing size from value investors, given their headline valuations, but Indian equity markets still have a lot of value stocks to offer. Rhythm adds that they are adding Vedanta to their focus list at the expense of Cummins India. Okay, interesting move there.
Let's get money market views. Important today, Bhaskar Panda of HDFC Bank believes that the recent reconciliatory tone of the United States towards China and North Korea is positive, with the US 10-year Treasury almost touching 3% before retracing. He believes all this is dollar positive, which can be seen in the dollar index moving higher, almost 92 incidentally. Bhaskar Panda expects USD INR pair to consolidate within an intraday range of 66.40 to 66.60. Bond calls equally important. Bhaskar adds that the confusion in the Indian money markets cannot be overstated, looking at various inputs coming across. The 10-year Indian benchmark yield, he says, is again moving towards recent high of 7.78. He expects a range of 7.72 to 7.78. Okay. Today, I don't think it goes to 7.72. It closed at 7.74. Will more likely remain north.
Okay, let's go across to Mangalam then for the world view.
Well, the key headline from the world view is the fact that the US 10-year bonds is within kissing distance of that 3% mark, a level last seen in Jan 2014, closer to that 2.99% mark. Wall Street, as a result, saw a bit of a decline. In fact, marginally below the flat line or around the flat line, 4-day losing streak on the Dow. And that one was led lower by Goldman Sachs, which was the key drag on Dow Jones. Consumer technology stocks, they were under pressure once again. So the FANG stocks, Facebook, Amazon, Netflix, as well as Google parent Alphabet, all of them ended lower in trade. But Alcoa, that one was the one which moved the most, down about 14%, as the US government has said they won't impose sanctions against Russia till October. So that postponement not doing too well, but it's doing well for the Russian index. In fact, while it gained close to about 2% from yesterday's low, it ended largely below the red line. We'll keep an eye out on how that pans out in today's session. Europe was by and large in the green, but one sector was doing not too well in Europe was the media sector. WPP fell in trade yesterday after Ford announced that they will trim the business its business with the company. This comes after Martin Sorrell's resignation. If you take a look at the Asian markets, by and large in the green, the Asian markets, the Japanese index is gaining on the back of a weaker yen. Hang Seng unchanged as of now, but the Shanghai index also gaining, recovering some of its underperformance. The SGX Nifty, well, earlier indicated a deeper cut. Now it has recovered, but still a cut of close to 10-15 points at the open.
Okay, thank you very much for putting all those cues on the table, Mangalam. And now let's invite our guests to tell us how to parse the global macros. Arvind Sanger, Managing Partner at Geosphere Capital Management, and Mark Matthews of Bank Julius Baer join us now. Good morning, gentlemen. Well, actually, good evening to Arvind and good morning to Mark. Thank you very much indeed for joining us. I think we are covering the globe antipodally with our guests. Well, first to you, Arvind. Is 3% 10-year good news or bad news? It signifies very good global growth. And then it signifies that money is going to come in expensive. What should it mean for an Indian investor?
Well, I think that it is a slightly less favorable macro. Clearly, everything else being equal, cheaper money is always better for equity markets. But if the expensive money is coming when growth is doing better, we can tolerate the more expensive money. So it's more expensive money is never better, but it's easier to handle if growth is better. And right now, growth seems to be better. But the, I guess, wild card that could upset the apple cart for India is oil, because if, inflation is going up and RBI is also having to raise rates, which, the last policy kind of, or the last minutes that came out suggest that that could be, more of a tendency to move in that direction. Those are all moderate, not significant, but moderate headwinds. And on the other hand, the global growth side, like you said, globally and in India, growth is getting better. So I think we have two opposing forces, and hopefully, and it seems to us, that growth will be more important as long as that remains, on track.
Okay, Arvind, hi, good evening. The big talking point yesterday was TCS and the company hitting $100 billion market cap. Indian IT has been left behind a bit, you reckon? Now it's a big comeback. And do you reckon it's backed by growth, or it's just valuation catch-up more than anything else?
I think it's a little bit of everything. I mean, let's be clear, Infosys guidance was not exactly, growth boosting in terms of the margin guidance they were giving. But I think the reality is that the rupee weakness creates a tailwind for those companies. And, again, global growth is fine. If this yield curve is steepening a little bit, that's good for financial, the banks and financial companies in the U.S. And that, in turn, turns out to be good for IT companies. So I think the IT companies, the valuations also on a relative basis to the rest of the market are somewhat, more reasonable to pay for growth. And so for a number of reasons, it can see a little bit of a buying. But, we still think, and yes, we are looking at some of the IT companies, but I think you were talking a little earlier about the metals and mining. And I think that's another area that we like. So I think some of the outward-facing sectors could also start to see more money going into those, and some of the easy money that's been made in the last 2 or 3 years in the banks and the NBFCs, you could see a little bit of a repositioning. But it's not like global growth is completely going away. It's still there. But, some of the easy winners of the last couple of years may not be the ones going forward.
Okay, we'll come back to you and ask you about those winners. You, of course, mentioned metals and mining, but let's invite Mark Matthews of Bank Julius Baer on our discussion as well. Mark, hi, good morning. How do you trade in an era of relatively higher rates? Because, historically, the stock markets have done well at times when inflation was higher, provided the economic momentum was good. Do you think this time could be the same?
Well, I can't really answer. I think the proof will be in the pudding over the next few weeks, how the market trades if the 10-year Treasury does stay at about 3%. And I don't know which one it is, whether the 3% on the 10-year Treasury being a reflection of strong global growth will provide some kind of comfort to investors, or the cost of money having become more expensive, they would demand cheaper prices in equities. I don't think the market is giving us very clear signals right now. We've been essentially trading in a very wide pattern since early February, and so yeah, I think it will continue to be that way going forward.
But instinctively, Mark, as you see money getting expensive or the yields, US Treasuries touching 3%, how would you reposition? Would you rearrange your pecking order in the emerging markets or even EM versus DM?
Well, I think in part it depends on what the dollar does. Historically, when interest rates in the U.S. go up, the dollar goes up too, but it hasn't been the case this time around. If the dollar were to start to strengthen, I think that additional combination of relative tightening of liquidity in the emerging markets might be a bit too much for them to bear. But then again, you know, the world is always in a constant state of change, and perhaps it's wrong of us to look back at history 10 years ago, 20 years ago, and assume that we should trade along the same parameters. And the reason I say that is that 10 years ago, China was a $30 trillion economy, and by the end of this year, it'll probably be a $13 trillion economy. So China, of course, has much more of an impact on the world than it did before, and therefore on emerging markets and global growth in general. And so what interests me is that although most asset classes are down year to date, one of the exceptions, broadly speaking, is emerging market equities. And that's kind of unusual because they are considered risky assets. So in a market where most prices are down, you would have expected them to be down even more than the average. But so far this year, in fact, they're up.
Arvind, comment on that point, because the fear is that, you know, the US economy could sort of meet its inflation target of 2% and thereby hike rates faster than what the street was expecting. But that was the fear that the street had even a couple of months ago. Do you think Indian investors need to worry about that?
I think so, because at the end of the day, India is not an island that's stealing from global economies. Let's be clear that India got a couple of major tailwinds in the last few years, one of which was a sharp fall in oil prices, you know, starting in late 2014. And that helped both from managing, the deficit, the current account and the fiscal deficit. And you had the tailwind of continued easy money around the world. Now, you know, the easy money has slowly, at least from the US side, been going out of the system or being pulled back. But I think if this accelerates this year, and people are talking about some estimates are there for, 4 rate increases this year, that certainly suggests emerging markets to catch a cold is becoming higher. So the risks are going up from a macro standpoint. Whether it'll cause, things to keel over or not in terms of markets is hard to call. But I think clearly those risks are there, and the oil risk, if oil keeps going and hits $80. Which is certainly not inconceivable. It's gone from 70 to 75 in the last few weeks. So, why could it not go further given how tight supply demand is looking? Those are, I think, factors to keep in mind that can cause a bit of a sell-off. Now, it doesn't mean it's the end of the cycle, but it certainly means that risk-off, you could see risk-off major corrections along the way.
Okay. Arvind, how big is politics a factor for this year? Yesterday we had, Christopher Wood of CLSA saying that the rally is at risk if PM Modi is not re-elected. Your thoughts on how, the build-up to 2019 could pan out?
Well, I think clearly political risk is higher today than we would have figured 6 months ago, not just because we're 6 months closer to the election, but also because the tea leaves are looking a lot more uncertain in terms of BJP's strength and Prime Minister Modi's strength. But I happen to believe that, India is more resilient than one man and one party. And therefore, and plus I don't believe that'll be a major shock. It may be a much more weaker BJP government, which may not be the worst thing in the world. I think India does well with weak governments. So it's not like strong governments cause great market performance and weak governments don't. But a weak BJP government is still, I think, fine. And I'm not that concerned from a medium to long term, but I think the market is going to. Okay. So from a market risk standpoint, that is another factor, along with, as you mentioned, the U.S. Interest rates as well as oil prices. Those are, to me, the three horsemen that India has to worry about as being harbingers of some risk in the market.
Okay. Well, we were just discussing before we invited you all about how many sectors in India could do well, and I wanted both of you to tell us what kind of sectors you would like. For instance, IT and cheaper rupee. Rupee is going to 66.50 now. That will mean steel companies and so many other companies facing import competition will have more pricing power. And on the other hand, I think consumption's looked very good this result season. Look at the NBFC numbers. Cholamandalam's disbursements have risen by 54%. I mean, the consumption is unbelievably strong. So, therefore, Arvind, what kind of sectors at these valuations, of course?
Well, so we're seeing great growth, and the real question is we're just coming out of several quarters of disappointments because of GST last and before that demonetization, and so growth is clearly accelerating. The problem with every cycle is growth is strongest before it rolls over, right? The recessions come because growth is very strong and banks have to raise interest rates, and then growth peters out. So I think the growth and the earnings recovery is going to be the story. But whether it is the financial companies, and we still own some NBFCs, and we think that is still room to play, or whether it makes to rebalance the portfolio a little bit in terms of some of the beneficiaries of a weaker currency and less affected by higher oil prices and higher interest rates. I think to us the mix has to include an environment where some of the growth drivers that we are starting to see may not have the same tailwinds that they had coming into the year. So therefore, this quarter's numbers are great, but we have to see what does $75 oil plus RBI raising interest rates mean for some of these sectors. So I still like some of the domestic sectors, but I think our preference would be to rebalance it a little bit with some which benefit from a weaker rupee. Okay,
Mark, what about you? I mean, IT has made a big comeback because most of these companies are making huge strides in terms of digital revenues. But what's your preference now in the Indian markets?